Hello everyone and welcome back to my YouTube channel. It's been a while, I know, but in this video I want to show you a strategy that I've been using lately, and that's using the MACD indicator. It's super simple and easy to follow. So without further ado, let's go ahead with the video. So to begin this video, I will go through the main elements of this strategy, including what is MACD, how to read MACD to analyze the market, and most importantly, how to utilize it properly in a trading strategy. So without further ado, let's go. I'm sorry if I will speak too much from time to time. It's just because I really missed making content and I'm talking to you guys. So understand, as this is the way of expressing my love to you all. So what is a MACD indicator? Well, the MACD is a technical tool, and I think you already heard about it, and it's used to detect new trends or a momentum. But basically what you get when you plot MACD lines on the chart is a picture of the relationship between EMAs. So to put it in a more simplified way, especially if you're a beginner, the MACD is a trend following indicator that shows the relationship between the moving price averages, or how two EMAs compare to each other over a period of time. This specific indicator is made up of three components, and especially if you're a beginner right now watching this video, you should be well aware what are those components. So there are two lines and a histogram. The MACD line is the indicator's faster line because it responds quicker and it's more sensitive, so that's why it tends to go above and below the indicator's second line. The second component of the MACD is a signal line, which is the second line of the MACD indicator, and it is referred to as a signal line since it produces the fundamental MACD signals. So because the line is a slower one, it is often broken by the quicker MACD line, as I mentioned before. So of course, the histogram is the last but most significant component of MACD. The histogram just basically illustrates the difference between the MACD and the signal line. The bigger the difference between the lines, the higher the bars on the MACD histogram. And this indicator often oscillates above and below the zero line, suggesting momentum and a potential shift in trend. So MACD already has its default settings, which are 12-day faster line and a 26-day slower line, with the number 9 indicating the previous 9 days. However, you may substitute different values based on your trading habits and goals, so always try the technique on them first to see if this is appropriate for you. I always have more to explain to ensure that you fully understand, so if you still need any more assistance, please do not hesitate to reach out to me. I will leave everything in my description box down below. There are two important ways to read MACD indicator, and the first one is to see whether the market is overbought or oversold. Take a look at this example. You can see that the MACD's indicator peaks corresponds to the price peaks. This is because the MACD tends to fluctuate between being overbought when it reaches a high and being oversold when it forms a low. In my personal opinion, traders may profit from knowing about the MACD indicator since it can warn them when the market is going to hit a new high or new low. And in order to reduce the risk, I think traders should reduce the length of their long positions around the highs and increase their short positions near the lows. There is another great way of using MACD indicator, so it's basically checking whether the market is moving up or trending down. And the MACD, unlike other technical indicators, does not have a restricted range, but it does have a zero line going through the center. And when the MACD exceeds 0, the trader may believe that the price is going in an uptrend, and when the MACD is less than 0, the trader may assume that the price is dropping with a downtrend. So how to apply MACD correctly? Well, the crossover approach is one way of using the MACD indicator, and I think it's unquestionably the most popular way amongst the traders. So in essence, a trader will watch the MACD two lines and buy when the vast line crosses the slower line below the zero line, so basically on the lower MACD zone. And this is because the crossover signal shows that the faster moving average line is quickly diverging from the slower, indicating the beginning of a new uptrend. And in most cases, this also indicates that sellers are tired, the market is oversold, and more than likely to see an extended rise to the upside. So please consider the following example on USD/JPY 4-hour time frame. We can see that the price has been trending towards an upside for some time, making higher highs and higher lows. We also have a few strong touches on the trend, confirming that we are definitely in a bullish market. And as we can see, the MACD formed formed a divergence, which is a connection of two lower highs. As we can see, the MACD line is now crossing the signal line, which is a slower one, and a crossover occurred below the zero line. Of course, guys, bear in mind that you don't trade every time you see a line crossing above or below zero line. You must consider other elements such as price action and any upcoming events, and even the key elements of support and resistance. They do play a huge part of trading. You should also be aware of this situation, and I'm gonna show you that once again, and I think that's the greatest way to identify an upcoming reversal and therefore how to handle your trade properly. So keep an eye now on the chart and the MACD histogram. When the MACD histogram's high decreases, there is a high probability of a change in direction or a slowdown in a price movement. When this happens, the MACD line is moving closer to a signal line, which is a significant trigger to be aware of when you're employing this MACD indicator into your trading routine. So now I will show you an example of when the MACD crossover strategy didn't work, why it didn't work, and how to prevent such situations in the future. So I have Euro CAD on a 4-hourly chart, and this situation is referred to be an overextended MACD line. These very high price fluctuations will be followed by sell-offs and vice versa, and buying at extreme highs and selling at drastic lows should be avoided. And here is an excellent rule to remember if you want to prevent situations like this. So basically, avoid buying when the MACD line is super extended into highs, and avoid selling when it's super extended into lows, because most of the time if we see these highs, it means that the movement has already been overdone and is prepared for the minor reversal. So what happened, it basically indicated us to buy with this lovely crossover, but what happened next is that it hit the stop loss and didn't even manage to reach the take profit want. Despite the fact that it may be difficult to detect, but with the practice, this tip may help you to save a lot of money and avoid going gray earlier than you should. So here is the main way that I use MACD in my strategies to achieve pretty damn good results. So here are the rules to follow if you decide to try this strategy yourself. Of course, a quick guide on how to add MACD to your chart is to go to the indicator section and basically type MACD. Alright, we have what we need. I will not adjust the settings of the MACD fast and slow length, but I will only adjust the signal line from 9 to the value of 7 just to get more accurate data. But I will also use 25 and 50 moving averages to assist me further on because they just work brilliant and say no more. So this way of trading MACD is a basic bullish MACD crossover. This is when the MACD line crosses the slower signal line in the bullish direction. So here is an example of a bullish MACD crossover on GBP JPY, which is my favorite currency pair to trade, and this is 2-hourly chart. Before the initial entry over here, we had a decent trend towards the downside. We can see that even the moving averages are nicely following the price down, but we also see a slight movement towards an upside, meaning that our sellers slightly getting exhausted and the buyers stepping into the market. Now, taking a look at the MACD histogram, the red bars that indicate selling pressure are now decreasing. They're just basically getting smaller, as you can see. This is an indication or even a trigger move you should look out for, because more than likely a possible change in trend direction is coming up. If you're an aggressive trader, you could potentially enter over here once the cross occurs, but if you're a beginner, do not dive straight away once you see a cross, but just be patient and wait for a nice entry. And this is the wait I am talking about. Now we see that the price has started to trend up. The moving averages are still slightly on the selling side, but if you have patience, you will see this nice push and exhaustion scenario. A bullish engulfing candle closed next to a moving average to support this buying trade opportunity, and even now MACD line is dominant, and that's why we see these huge profits. So to summarize everything in this video, what I wanted to say is basically when you're entering the trade utilizing the MACD indicating strategy, you should always use a stop loss order to protect your position. So to successfully set a stop loss order, just basically check your chart for any previous areas of sensitivity, any chart patterns that could help you to plot it, or even any swing points basically for the price movements. And if you're entering a long position, you may want to set your stop loss below a previous chart bottom, or if you're trading short, your stop loss order may be placed above a previous top.